Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was scrolling through Twitter, and sometimes I get some information from Twitter. This guy, Rogue Mad, it says, using a comprehensive list of uranium miners as a stepping stone, I applied a TV indicator known as the omega ratio to see which ones have better returns than Denison mines. So, in theory, you get more bang for your buck with these and less with the rest. Um, he's looking at returns, the omega ratio. Granted, I haven't heard of it, but it's obviously a ratio that compares returns over time. I don't know the time frame that he used on this, but I do look at all of the uranium companies on a regular basis, charting, looking at returns, doing all these things, and I migrate naturally to what would be called the omega ratio. So that's what I call the quote bounce. Whatever has the most bounce, whatever has the most leverage to the move is what I've been looking for over time. And if we look at this, this is compared to DNN. DNN is here. They've got UROI above it. What it's saying is that UROI is a little bit higher leveraged to the price moves of DNN, and that's exactly what I've seen. So I do believe that this is probably a true comparison. I think the data is right because I watch these things, and these are uh, uranium companies that have a better omega than DNN. It has more leverage and better returns than DNN. The companies on the right-hand side here are UROI, ISENF, which is ISO Energy, Encore Energy, Bannerman, Peninsula Energy, Forcis Metals. I don't know what this one is. TOEYF, Western Uranium, Fission 3.0. I don't know what OKR is. Blue Sky Uranium. I think that one. This one's the Spain one. I think it's Berkeley. Azarga, VEGYF. I'm not sure what that is. Pure Point Uranium, Sky Harbor, Anfield, Forum Energy Metals, ALX. I don't know what D9, L9, LN is, and then POW. The ones that I have done research in and the ones that I think that have a lot of bounce, just based off of my own, I would say, my own analysis and the ones that I prefer. The ones in this list here would be Bannerman for sure. Bannerman, Encore Energy, Deep Yellow, Forcis Metals, Goviax. Now, when you look at these things, you can do this type of analysis. You can look to see what the leverage is. But sometimes companies react differently depending on the price. A high cost producer may lag in the beginning of a move. And then when you get above their cost to produce, their break even costs, their cost curve, so to speak, they can start going buck wild, so to speak. So I prefer kind of the higher cost producers because usually they lag in a bull market going in the beginning of the bull market, and then they just take off at the end. So I've been preferring the African crew is what I call it, the African companies. Doesn't mean that's the best. I also have a bunch of Canadian and I also have some American. But from what I've seen, if I were to just to take a look at it, I mean, I think UEC is also pretty leveraged to the move. I didn't see it on here. I don't know if that's part of the analysis, but I would say UEC and DNN are pretty close just by looking at it. And I haven't really gone towards the larger companies. I do own NXE, Next Gen Energy, but the African countries are the ones that I think they're gonna push it. Global Atomic should be on here. I don't know if he put that in his analysis, but Global Atomic is beating a lot of almost everything. It's one of the top performers. So I know Global Atomic is up there as well for performance. Another thing I want to talk about, the Lassonde curve. And I haven't talked about it for a little while. What this is it's a curve for mining companies. This is kind of the, see if I can pull this thing up here real quick, show you guys what the Lassonde curve. It's the stages. It's visualizing the life cycle of a mineral discovery. Here is the life cycle here. Let's get me out of here. The life cycle of a mineral discovery. The risks are fluctuating commodity prices, funding risk, technical risk, and exploration risk. Most investors, what we want to do is position ourselves somewhere in before this big move and before this big move. What you'll see in my portfolio is that they're mainly composed of exploration companies, which I have a lot less money in. This is speculating that the initial drill results provide some insight as to what truly lays beneath, but more work is necessary to define a mineable deposit. Early speculators buy into the project. That's here, and this is your value of that company. You go from having a piece of land pre-discovery to having a discovery that's well defined. But then after you have that discovery, interest wanes and it goes back down. So this is kind of your big initial burst of pricing, and then it'll go into a lull period before they create a development of a mine. This is a mine building phase here. So exploration phase, mine building. The companies that I mainly own are here and here. I don't own any of the producing companies as much. I own some, but it's not nearly as much because when they're operating the mine's now open and the company can extract ore and generate cash flow. Risks such as fluctuating commodity prices still remain. If you're over here, you're already high valued because you're a producer. You're basically left with the fluctuation of the commodity. If you're here or you're here, this one is very, very low value. It's basically valued like it doesn't have anything, which, fair enough, they don't. But when they find something, they jump in the valuation quite dramatically. And if you're in a fluctuating commodity price, if it's going up, you can get some of the highest returns in this area here. The other one is when companies get revalued from no mine to a mine. So they have a deposit, but they have to put technical work into it and spend money to get this into an operating mine. Once they get into an operating mine, they are fully valued for whatever that commodity price is at that time. You don't have the leverage to move the needle from a low enterprise value per pound to a higher enterprise value per pound. So what I'm doing with a lot of my investments is kind of getting the companies that are producing mines and going to build them over this uranium cycle to go from a low valuation to a higher valuation in terms of enterprise value per pound. The other ones are obviously ones seeking uranium deposits and defining those deposits, which can add a ton of value, but is a lot more risky. I would say that these are a lot less risky because they have deposits, roughly how many pounds they have. Obviously, they can increase that with a little bit further exploration, which will add value to the shareholders. But if you're already in a producer, you're up here and you're already going into highly valued companies. Now, if you're in a huge bear market and you go up to the right-hand side over here and you invest, those valuations could be very low, and you just make it off of the commodity price going up. Basically, they're pounds in the ground getting revalued higher from the commodity price, which is probably the least risky way to do it. But if you're looking for leverage, you want to go into a developer and or an explorer, but the explorers hold a lot more risk. So I put a lot less money in the explorers. I favor the developers a lot more, and then you've got the producers, which I don't really have too much money in. So I just wanted to cover all that. The Omega curve, the companies that I see are the African companies. Those are the ones that I really like. Some of these Canadian ones, if you were to look and you were to talk or look at Twitter and see what people are tweeting about, Denison Mines is a popular one. UEC is a popular one. ISO Energy seems pretty popular. UROY seems very popular. And Bannerman and some of the African ones, Deep Yellow, they seem pretty popular as well. And that's where the ones that have the highest Omega are at. It's the ones that people are always talking about where the money is flowing the greatest into it. So I wanted to touch on all this, give you guys a little bit more analysis to think about if you're evaluating companies. All those companies that I just listed there, Bannerman and all them, they're at this stage right here. The exploration companies that I own, Baseload Energy, Canalaska, Sky Harbor, Pure Point, Uranium, Standard Uranium, they're all in the exploration phase and carry a lot more risk. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.